Imagine you own an asset. And overnight, the market just goes completely wild.
Right, just a massive spike.
Exactly. And suddenly the market says this asset is worth, 50% more than what you originally paid for it.
Which is a dream scenario for any business.
Oh, absolutely. If you're a business owner or, a CFO, you are absolutely thrilled. You're ready to celebrate.
Naturally.
But then your auditor walks into your office, sits down, and tells you that legally, under the accounting standards, you must record an impairment loss on that exact same asset.
Which just ruins the whole celebration.
Totally ruins it. I mean, how on earth can an asset be skyrocketing in market value while simultaneously being deemed impaired and requiring a direct hit to your profit and loss statement?
It sounds completely impossible.
It sounds like a total contradiction, right? Like accounting gone completely mad.
Yeah. So welcome to a brand new deep dive on the Gap Advisors Ind AS Kill Clinic podcast.
It really is a scenario that causes just a tremendous amount of friction in boardrooms.
I can only imagine the shouting matches. Oh, yeah. Because it is entirely counterintuitive, until you actually understand the underlying architecture of the standards.
And that is exactly our mission today. We are taking a really laser-focused look at one of the most perplexing mechanics in financial reporting.
The treatment of debt investments under some very specific fair value rules.
Right. So whether you are prepping for a highly contentious audit committee meeting or you're just a finance professional trying to stay ahead of the curve, we are going to untangle this paradox.
Step by step.
But before we get into the heavy machinery of the accounting, where exactly are we pulling this the specific maddening scenario from?
So this scenario comes straight from the trenches. It's drawn directly from the issue repository on gapadvisors.com.
Which is a massive resource.
It really is. For the professionals listening who deal with Indian accounting standards on a daily basis, you likely already know this site.
Yeah, it's pretty ubiquitous in the industry.
But for those who don't, the site hosts an archive of over 4,500 specific, highly technical issues and their detailed responses.
4,500 plus? That is just a staggering volume of real-world problems.
Covering both Ind AS and Indian GAAP.
Right, so it's not just, theoretical textbook stuff. These are the actual roadblocks that finance teams are hitting every single day.
Precisely. And any person can register on gapadvisors.com for free and submit their own issues regarding Ind AS and Indian GAAP.
Which is incredibly useful.
Extremely. You just submit the query, and a detailed, comprehensive response is delivered directly to the inbox of the email you registered with on gapadvisors.com.
I imagine that's a lifesaver for documentation.
Oh, particularly for auditors.
Yeah.
I mean, an auditor who needs to meticulously document exactly how they addressed a highly nuanced issue on the application of Ind AS, having that detailed response sent straight to them is just incredibly valuable.
So, to anchor today's discussion, the specific issue we are dissecting was featured in the 227th edition of the Gap Advisors Task Weekly newsletter.
Right, which is authored by C.A. Manish C. Iyer,
who is the director of Gap Advisors. And that newsletter is published regularly on LinkedIn, right?
It is. They've actually published over 230 editions of that newsletter to date.
Wow.
So it's just this constant stream of high-level analysis.
It's amazing. Now, a crucial piece of housekeeping before we pull this specific scenario apart.
Yes, very important.
The views expressed in this deep dive today are entirely personal views.
Right, they are not binding on you, our audience.
Exactly. We highly request that you seek the help of a qualified professional expert before taking any action or, refraining from any action based on the views we discuss herein.
Because every single business transaction has its own unique, highly specific variables. We are just exploring the mechanics and the philosophy of the standard today.
Always consult your own experts. Okay, now let's establish the boundaries of the universe we are operating in today.
Setting the stage.
Right. We are looking at a standard reporting period. So the beginning of the reporting period is the 1st of April, and the end of the reporting period is the 31st of March.
Standard financial year.
Yep. And to keep our math grounded, we are dealing entirely in Indian rupees.
Perfect. So let's get into the core query.
Okay, let's unpack this. Here is the dilemma straight from the listener query we found in that source material.
Let's hear it.
It revolves around a debt instrument that is measured at fair value through other comprehensive income.
Which we generally call FVTOCI.
Right, FVTOCI. Now, the rule is that any impairment on this FVTOCI instrument must be charged to the statement of profit and loss.
That is the rule, yes.
Now, here is where my logic And clearly the logic of the person who submitted this issue to GAAP advisors just completely derails.
Okay, why?
Doesn't fair value, by its very definition, already account for credit risk and time risk?
That is exactly the assumption most people naturally make.
Right. I mean, if the open market gives you a fair value price, the market has already factored in all the variables.
They've done all the math.
Exactly. It's priced in the interest rates, the liquidity, and crucially, the risk that the borrower might actually default.
A credit risk.
Yes. So if the market has already done the heavy lifting of pricing in that risk into the current value, how is it even possible or, logically sound to segregate the extent of impairment out of that single fair value number?
It is a brilliant question because it exposes this fundamental misunderstanding of what a fair value number actually represents in the context of different accounting models.
I was trying to conceptualize this earlier, and let's step away from complex bonds for a second. Let's think about buying a used car.
Okay, I like car analogies.
Right. So let's say I go to a dealership, and the market price, the fair value of this specific car, is 500,000 rupees.
Okay, 500,000 rupees.
Now, that 500,000 rupee price already factors in the reality that the car has a slightly faulty engine.
Right, it's not in perfect condition.
Exactly. The engine represents our credit risk in this analogy. The dealer knows the engine is sputtering. I know it. The whole market knows it. It is entirely priced in.
Because if the engine was perfect.
If it was perfect, the car would be worth maybe 700,000 rupees.
Right.
But it's not. It's 500,000. So if I buy it, why is the accounting standard essentially forcing me to separate the engine repair cost from the car's overall market value?
Because the market already did the math.
Yes. Why am I doing it again?
What's fascinating here is that your used car analogy perfectly highlights the intuitive trap that finance professionals fall into.
It feels like a trap.
It really does. You are absolutely right that a true open market transaction price, the fair value factors in that faulty engine.
So I am right.
You are, but here is the critical distinction we have to make. And this comes directly from the source material discussing paragraph 4.1.2a of Ind AS 109 financial instruments.
Okay, what does paragraph 4.1.2a say?
It essentially points out that the change in fair value that is recognized in other comprehensive income under the FVOCI model is not a clean fair value.
Okay, wait. Not a clean fair value. That phrasing is doing a lot of heavy lifting right there.
It really is.
What exactly makes a fair value unclean? Because if I see a price ticker on a Bloomberg terminal, that looks pretty clean to me. It's just a number.
Well, to understand what unclean means in this specific framework, we first have to understand what clean looks like.
Okay, walk me through the clean version.
Let's briefly contrast our complex FVOCI scenario with a much simpler classification.
Which is?
An instrument measured at fair value through profit or loss. We call that FVTPL.
Right, FVTPL.
In the FVTPL world, the change in fair value is a change in clean fair value.
So how does that work mathematically?
Let's use the baseline numbers from our source material. Imagine the fair value of a debt asset on initial measurement is 100 rupees.
Okay, we buy it for 100 rupees.
Right. On subsequent measurement, say, at the end of the reporting period on the 31st of March, the fair value has jumped to 150 rupees.
A nice 50 rupee gain.
Exactly. Now, if that asset is classified as FVTPL, life is incredibly simple.
How simple?
The entire change in fair value, which is that 50 rupees, is recognized directly in the profit or loss statement as a fair value gain.
Just boom, straight to the P&L.
Straight to the P&L.
So no segregating the interest, no extracting impairment.
None of it.
The asset went up by 50 rupees, I claim a win of 50 in my P&L, and I go home early.
Exactly. It is an all-in-one, clean movement. The market dictates the value, and your P&L reflects that exact market movement, warts and all.
Okay, so FVTPL is easy street. It basically treats the asset like a pure trading instrument.
You buy to sell it, you market to market, you take the gain or loss.
But our scenario isn't FVTPL.
No, it is not.
Our asset is living in this highly specific FVTOCI environment.
Which is much more complicated.
Yeah, so why are we forcing this asset into this complex dual tracking world where the fair value suddenly becomes unclean?
We end up in this complex situation because the asset and the company's intention for that asset meet very specific criteria.
Because you can't just choose whatever method you like best, right?
Oh, absolutely not.
Yeah.
And AS 109 does not let you just pick your favorite accounting method. You are dictated by the economic reality of the instrument and your business model.
Okay, so what's the first hurdle?
First, the asset must pass what we call the SPPI test.
SPPI, which stands for?
Solely payments of principal and interest on the principal amount outstanding.
Okay, so what does that actually mean in plain English for someone who isn't deep in standard-setting jargon?
It means the debt instrument is a straightforward, plain vanilla lending arrangement.
Just the basic loan.
Right. You lend money, you get your original money back at a specified date.
The principal.
Exactly. And in the meantime, you receive interest that compensates you for the time value of money and the basic credit risk of the borrower.
So it can't have, like, bizarre equity kickers or performance multipliers tied to the price of gold or something.
Correct. If it has those exotic features, it completely fails the SPPI test.
And what happens then?
It gets kicked right over to the FVTPL category we discussed earlier.
Because it acts more like a complex derivative than a simple loan at that point.
Exactly. But meeting the SPPI test is only hurdle number one.
There's more.
Always more. The second, and arguably more important criterion, relates to the entity's business model.
Right, the why do we actually own this thing test.
That's a good way to put it. To be classified as FVTOCI, the entity must have a dual-purpose business model.
Dual purpose.
The source text states the entity's practice must be to sell assets for purposes other than credit risk management, while simultaneously holding them to collect contractual cash flows.
Okay, let me make sure I'm translating this correctly. You aren't just buying these bonds, throwing them in a vault, and waiting 10 years for them to mature.
Right, that would be a pure hold-to-collect model.
But you also aren't sitting at a terminal day trading them every 10 minutes to capture tiny price fluctuations.
Because that would be a pure trading model, FVTPL.
Exactly. So you are living in this gray area.
Precisely. You are in the middle ground.
Can you give me a real-world example of who operates in that middle ground?
A great example is a bank's liquidity portfolio.
Okay.
They buy these highly rated government or corporate bonds primarily to collect the steady, predictable interest payments.
Right, they want that yield coming in every month.
Exactly. However, if a sudden liquidity crisis hit,
Like a run on the bank.
yeah, and the bank needs cash immediately to fund customer withdrawals, they will absolutely sell those bonds on the open market.
So they hold them to collect, but they are fully prepared to sell.
Right. Or if interest rates shift dramatically and it makes strategic sense to sell a bond and lock in a massive gain to rebalance their portfolio, they will do it.
Okay, so because the entity lives in this strategic middle ground, the accounting standard demands that the financial statements reflect both potential realities.
That is the entire philosophy behind ASL 109.
Both realities at once.
Yes. The standard setters, like the IASB, looked at the chaos of previous financial crises, particularly 2008, and realized that allowing companies to obscure their true risk profiles behind single blended numbers was dangerous.
Because it hides what's actually happening.
Exactly. The standard wants stakeholders reading the financial statements to see the current fair value, because the entity might actually sell the asset tomorrow.
They need to know what it's worth right now in cash.
Yes. But the standard also wants stakeholders to see the amortized cost, because the core operational intent is still to collect the principal and interest over time.
I have to say, this feels incredibly convoluted.
It is definitely complex.
Is there a genuine economic benefit to forcing companies to jump through these dual tracking hoops? Or is this just, standard setters justifying their existence and creating busy work for finance departments?
It's a fair question.
Because tracking amortized cost completely in the shadows while reporting fair value to the public, it sounds dangerously close to keeping two sets of books.
I hear that complaint a lot. And it is a massive operational burden. There's no denying that. Finance teams have to maintain highly sophisticated systems just to manage this dual reality.
Right.
But the economic benefit of transparency is immense. Let's really unpack what amortized cost actually is conceptually.
Please do, because it sounds like a phantom number. It's a number that exists but doesn't exist.
Amortized cost strips away all the erratic noise, all the panic, and all the exuberance of the open market.
Okay.
It completely ignores what the bond traders are screaming about on any given Tuesday.
It doesn't care about the news cycle.
Not at all. Instead, it looks strictly at the original amount you paid, minus any principal you've received back, plus the accumulated effective interest.
So it's just pure math based on the contract.
Yes. It represents the steady, mathematically inevitable economic yield of the instrument based solely on the contract you signed on day one.
So if I buy a bond yielding 5%, the amortized cost track is just slowly, methodically clicking upward at 5%.
Like a metronome.
Completely deaf to the fact that the actual market value of the bond might be crashing or soaring outside the window.
Exactly. It represents your operational yield.
The unshakable internal truth of the contract.
Well put. And by forcing companies to track this internal truth, Ind AS 109 prevents management from hiding operational decay behind market windfalls.
Oh, okay.
Or conversely, it prevents them from taking massive operational write-downs just because the market threw a temporary temper tantrum.
Okay, I understand the philosophy now, but keeping this purely theoretical is making my head spin.
Let's ground it.
Yes, let's bring this down to earth. Let's take this step-by-step mathematical example directly from the source text and walk through the chronological journey of this asset.
Let's see how this dual tracking actually behaves in practice.
Exactly. Here's where it gets really interesting. Let's start at the beginning of our reporting period. Day 1, the 1st of April.
Okay, day 1.
The entity goes out into the market and buys this debt investment.
And according to our source from Gap Advisors, the fair value on initial measurement is exactly 100 rupees.
Right. Now, I'm not going to bore our listeners with the basic mechanics of buying an asset. We all know how this works.
It's accounting 101.
Exactly. You drop 100 rupees of cash from your bank account, and in exchange, you get an asset on your books.
So the finance team records journal entry number 1.
Debit the asset debt investment at FVOCI for 100 rupees.
And credit the bank for 100 rupees. Simple.
It is simple on day 1. At this exact second, the 1st of April, the dual tracks are perfectly aligned.
Right, there is no divergence yet. The external fair value is 100 rupees, and your internal amortized cost is exactly 100 rupees.
But as soon as the clock ticks past midnight, those two realities begin to diverge.
Because time equals money.
Exactly. Time passes. We march through the months, May, June, July, moving steadily toward the end of our reporting period on the 31st of March.
And as time passes, this debt instrument is generating interest.
The source provides our next critical variable here. We are assuming the amortized cost of the asset is going to move with interest calculated on an effective interest rate basis.
The EIR basis.
Right, the EIR basis, and that calculated interest is 10 rupees.
And crucially, the source notes there are no actual cash inflows yet.
So we haven't received a check in the mail.
No cash has changed hands.
This brings us to journal entry number 2, which is entirely focused on updating that silent internal amortized cost reality we discussed.
The hidden track.
Exactly. The entry the source provides is debit debt investment at FVOCI for 10 rupees and credit interest income for 10 rupees.
So let's pause and dissect the why of this specific entry.
Yeah. Why are we using this specific effective interest rate method? And why does that 10 rupees go straight to the profit and loss statement as income, even though we haven't seen a single rupee of actual cash?
You use the effective interest rate because it is the true economic measure of your return over time.
Okay.
It doesn't just look at the coupon rate printed on the physical bond.
Because that can be misleading.
Very. The EIR factors in any premiums or discounts you paid when you initially bought it, spreading those costs or benefits smoothly over the entire life of the instrument.
Smoothly is the key word there.
Exactly. And why does it go to the P&L? Because under standard accrual accounting, you have truly earned that economic return simply by holding the asset over time.
You've provided the capital, so you've earned the return.
Right. It reflects the time value of money that the borrower contractually agreed to pay you.
So by crediting interest income, the company is basically telling its shareholders, look, our core lending operations successfully generated 10 rupees of fundamental yield this year.
Exactly. It's a measure of operational success.
And by debiting the debt investment asset account, you are effectively establishing the new baseline for your amortized cost.
Yes, you are updating the internal truth.
So the original 100 rupees plus the 10 rupees of earned but uncollected interest means your internal amortized cost track is now sitting at 110 rupees.
110 rupees, correct.
Okay, so if we were allowed to just ignore the market completely, like if we were in a pure hold-to-collect model, our asset would just sit comfortably on the balance sheet at 110 rupees and we'd be done for the year.
You'd run the trial balance and go home.
But we can't ignore the market.
We absolutely cannot.
We have that dual-purpose business model. We hold to collect A and D sell.
Which means the outside world is dictating a totally different reality.
Right. So we reach the 31st of March, the very end of our reporting period, and we look up the market price on a trading terminal.
So subsequent measurement.
Exactly. And the new fair value is determined to be 150 rupees.
This is where the FVOCI engine really revs up.
And where the accounting gets genuinely fascinating.
Yeah.
We have a massive fair value spike. The asset jumped from a baseline of 100 rupees to 150.
And because of our specific business model classification, we know with absolute certainty that the asset must be presented on the face of the balance sheet at its true current fair value.
Which is 150 rupees.
That is non-negotiable. The standard requires it.
So we have to bridge the gap between our internal reality and the external reality.
Let's do the math that the source walks us through.
Okay. Our internal, behind-the-scenes amortized cost is currently sitting at 110 rupees.
Right. The 100 original plus the 10 interest.
But our target destination on the balance sheet is 150 rupees.
So the gap between those two numbers is exactly 40 rupees.
We need to boost the asset's carrying value by 40 rupees.
Which brings us to the third journal entry in our sequence.
Okay, let's hear it.
To bridge that specific 40 rupee gap, we debit the debt investment at FVOCI asset account for 40 rupees.
Let's verify the asset account balance now, just to be sure. We had the initial 100.
Plus the 10 from the accrued interest.
Now we add this new 40.
That totals exactly 150.
The balance sheet is perfect.
Yes.
It reflects reality.
It matches the terminal.
But every debit needs the credit.
Always.
So if I have a 40 rupee gain, traditional logic says I throw that on the P&L, right? I take the win in my net income, and I report a blowout quarter to the investors.
I assume that's what happens here.
If you did that, the standard setters would fail your audit immediately. Wait, really? Why? A gain is a gain. The asset is worth more.
It is a gain, but it is a very specific type of gain.
How so?
The source explicitly states we must help it debt investment OCI for 40 rupees.
OCI.
OCI being Dordan 5.
Okay, I need to push back here. Why OCI? Why are we hiding this massive 40 rupee win in this obscure equity section instead of letting it shine in the profit and loss statement?
Like we did with the 10 rupees of interest.
Exactly. We let the 10 rupees go to P&L? Why not the 40?
If we connect this to the bigger picture, it really comes down to the fundamental philosophical difference between realized operational yield and unrealized market fluctuation.
Unrealized being the key word.
Exactly. Let's think about the real-world implications of letting that 40 rupees flow directly into your net income.
I mean, I'd report massive profits.
Yes, you would. And what do companies do when they report massive profits?
They pay out dividends to shareholders. They pay massive bonuses to executives.
Naturally.
Right.
But you haven't actually sold the asset.
Ah.
You haven't realized that 40 rupees in actual cash.
It's just numbers on a screen.
It is a paper gain driven purely by market sentiment. Maybe global interest rates plummeted, making your older fixed-rate bond suddenly highly desirable to traders.
So the price spikes.
But you are still primarily holding that bond to collect the regular cash flows. If you pay out real cash dividends based on a paper gain, a gain that could vanish tomorrow if interest rates tick back up, you could bleed the company dry of actual liquidity.
Oh, wow. You'd literally be paying out cash you don't have based on a market mood.
Exactly. And that is incredibly dangerous.
Ah. So OCI is essentially a quarantine zone.
That's a great way to look at it.
It acts like a holding pen. It captures the external market reality, so the balance sheet is deadly accurate, showing the asset at 150 to anyone who asks. But it fiercely protects the P&L from the noise.
It ensures the P&L remains focused strictly on the true, realized interest earned from actual operations.
It is remarkably elegant when you view it as a protection mechanism rather than just arbitrary accounting rules.
It really is. The financial statements are basically communicating two distinct vital messages simultaneously.
Right.
The balance sheet says, here is our liquidation value today.
If we had to sell everything right now.
Exactly. Yeah. But the P&L says, here's what our core operations actually yielded. It prevents the volatility of the market from distorting the true operational narrative of the company.
Okay, so far, the story is incredibly positive.
Very positive.
The asset value is way up. We've earned 10 rupees of solid interest. The balance sheet looks incredibly robust.
Everything is going great.
But then, the reality of credit risk rears its head.
And this brings us to the most confusing part of the listener's query and the real twist in our source text from Gap Advisors.
Yes, we finally arrive at the expected credit loss, or ECL.
This is the impairment shock that prompted the entire deep dive.
Exactly. The source text states that based on an ECL calculation, there is an impairment loss of 10 rupees.
10 rupees of impairment.
Now, I am going to channel the absolute frustration of every CFO listening right now.
Go for it.
Wait a minute. We just spent 20 minutes establishing that the fair value of this instrument jumped from 100 to 150 rupees.
We did.
The open market is screaming that this asset is doing amazing. It is highly sought after.
Everyone wants it.
How on earth can the accounting standards justify forcing us to record an impairment loss of 10 rupees on an asset that just gained 50 rupees in total value?
It feels entirely contradictory.
It feels like we are double counting the bad news. I mean, didn't the market already factor in the credit risk when they priced it at 150?
This is the exact paradox that trips people up, and it all comes back to your used car analogy from earlier.
Right, the faulty engine.
You were assuming that the fair value of 150 already accounts for all the risk, so doing an independent, separate ECL calculation feels entirely redundant.
Well, why do the math twice?
Exactly. But to understand why it is not redundant, we must look at the source's rigorous definition of what ECL actually is.
Okay, define expected credit loss for me.
Expected credit loss is strictly the present value of cash shortfalls.
Define a cash shortfall in this highly specific context.
A cash shortfall is the exact difference between the cash flows that are due to an entity in accordance with the legal contract and the cash flows that the entity actually expects to receive in reality.
Wait, so ECL has extreme tunnel vision.
Extreme.
It doesn't care about market prices at all?
Not one bit.
It doesn't care about yield curves or global liquidity or any of that?
It only cares about one highly specific question. Is the specific borrower who signed this contract going to pay me exactly what they promised on the exact day they promised?
Precisely. ECL is a pure, unadulterated assessment of the specific issuer's creditworthiness.
It isolates the default risk from all other market variables.
Okay, but you still have to answer my critical question. How can fair value rise by 50 rupees while creditworthiness simultaneously falls by 10 rupees?
Yes. Paint me a picture of how that actually happens in the real world, because it's frankly impossible. It happens much more often than you think during massive macroeconomic shifts. Let's create a real-world scenario.
Okay.
Think back to the sheer economic chaos of the year 2020.
Oh, boy.
Global lockdowns are initiated. In response, central banks around the world aggressively slash interest rates to near zero to stimulate the economy.
Right. Money becomes incredibly cheap, almost free.
Exactly. Now, suppose 2 years prior, in 2018, your company bought a massive bond issued by a major international cruise line.
Okay, I'm holding a 5% cruise line bond in 2020.
Let's say that bond pays a fixed 5% interest rate.
Got it.
Suddenly, the global interest rate drops to essentially 0%. Any new bond being issued pays almost nothing.
Because rates are on the floor.
Yes. So your 5% fixed-rate bond suddenly looks incredibly attractive to yield-starved investors. The general market demand for that 5% return skyrockets.
Because nobody can find yield anywhere else.
Precisely. Because of that massive drop in general interest rates, the fair value of your bond is driven up dramatically.
It goes from the 100 you paid up to 150.
Okay, that perfectly explains the massive market spike. The math makes sense. My asset is worth more because my locked-in yield is vastly superior to the current market rate.
Right.
That is the fair value reality. But simultaneously, let's look at the specific company that issued your bond, the cruise line.
Okay.
The year is 2020. Their entire fleet is anchored. They have zero revenue coming in. They are bleeding millions of dollars a day in maintenance costs.
They're essentially burning cash.
Exactly. So the probability that they will actually survive to pay back your principal at maturity has decreased significantly. Your expectation of a cash shortfall has increased. The risk of default has spiked.
So even though the bond is technically worth more because of the yield,
Therefore, you have a mathematically quantifiable expected credit loss.
that is the aha moment right there. The market price went up because of broad macroeconomic winds, the dropping interest rates, but the actual microeconomic risk of default by the specific borrower got objectively worse.
Exactly. Those two things can and do happen at the exact same time.
So the overall fair value is basically a massive, complex stew of variables. Interest rates, liquidity premiums, inflation expectations, and credit risk.
It's all mixed together.
And by requiring a separate ECL calculation, Ind AS 109 is essentially forcing us to extract just one specific bitter flavor from that stew, the pure credit risk.
Beautifully synthesized. You extract the credit risk because standard setters fundamentally view credit losses as a basic cost of doing business when you're in the business of lending money.
It's part of operations.
Exactly. Credit losses aren't market noise. They are operational realities. If you make a bad loan to a failing cruise line, The standard demands that your profit and loss statement reflect that specific operational failure.
Regardless of whether a lucky drop in global interest rates happens to be masking the problem on your balance sheet.
Precisely. You don't get to hide a bad credit decision behind a lucky macroeconomic shift.
Which leads us to the final and frankly the most mind-bending journal entry in this entire saga.
Journal entry number 4.
Yes, we need to actually record this 10 rupee impairment loss. The source gives us the entry. Debit impairment loss for 10 rupees.
Now, we know from basic accounting that an impairment loss goes straight to the profit and loss statement, immediately reducing our net income.
We take the pain on the P&L.
Right.
But what about the credit side of the entry?
This raises an important question, and this is the exact spot where traditional textbook accounting intuition completely breaks down.
It really does, because if I record an impairment loss on a normal asset, say a piece of manufacturing machinery or inventory in a warehouse, or even a basic loan held purely at amortized cost, the standard reflexive practice is to credit an allowance account.
Right, a contra asset account.
Exactly. That allowance account directly reduces the carrying value of the asset on the balance sheet. You're essentially telling the world, this asset is damaged goods, we are marking its value down.
If your warehouse inventory is obsolete, you write it down. The asset visibly shrinks on the balance sheet.
But wait, we just established, as a non-negotiable rule of the FVTOCI business model, that the debt investment must stay at its true, externally verified fair value of 150 on the balance sheet.
That is the rule.
If we credited the asset account directly, or if we created an allowance contra account that netted against the asset, the overall balance sheet presentation of that asset would drop from 150 down to 140.
And that would be a lie.
Exactly. The market just told us it is worth 150. You can't artificially lower it.
Exactly. You are trapped by the rules of the framework. You absolutely cannot reduce the balance sheet presentation value below the true observable fair value.
Okay, so you have a debit to the P&L for 10 rupees, but you can't credit the asset.
Where does the missing credit go?
The source states explicitly, this impairment loss of 10 is recognized in profit or loss, and the loss allowance is recognized in other comprehensive income.
We are throwing the credit into the quarantine zone.
Yes, we are putting it in the holding pen.
You credit other comprehensive income.
So you are effectively debiting the P&L to force the company to take the operational pain of the deteriorating credit risk.
But you are crediting the OCI equity section to ensure the balance sheet asset remains whole and untouched at its true market value of 150.
That is wild.
It is a highly engineered solution.
We now have 4 separate journal entries pulling this single debt investment and the financial statements in several completely different directions.
It's a lot of moving parts.
We've got steady interest accruing one way, massive fair value spikes pulling another way, and impairment losses playing this bizarre tug-of-war between the operational P&L and the equity quarantine zone of OCI.
I feel like I need an aspirin just thinking about it.
So what does this all mean when the dust finally settles? Let's synthesize this entire journey for the listener who just needs to understand what their final printed balance sheet and P&L actually look like when they hand them to the board of directors on the 31st of March.
Let's do the final reconciliation based on the mechanics our source provided.
Let's lay out the final picture, statement by statement. First, the balance sheet.
Okay, if an investor or a regulator looks at the asset side of your balance sheet, the debt investment proudly and transparently sits at 150 rupees.
Undiminished.
Exactly. This is its ultimate, irrefutable, market-tested fair value. The balance sheet is communicating exactly what the asset could be sold for today if you needed the cash.
It provides pure transparency regarding liquidity. No hidden write-downs obscuring the true market value.
Correct.
Okay, what about the profit and loss statement? What story is that telling?
The P&L tells the unvarnished operational story of the period.
Right.
In the P&L, you will see a line item for 10 rupees recognized as interest income.
Okay.
This represents the time value of money you successfully earned based on contract.
The core business yield.
Exactly. However, further down in the P&L, you will see another line item. 10 rupees recognized as an impairment loss.
So you see both sides.
Yes. This represents the objective deterioration in the expected contractual cash flows, the increased risk that the borrower won't actually pay.
So the net impact on the P&L for the entire year is exactly 0. 10 rupees of income minus 10 rupees of impairment.
Yes, the net is 0, but the gross presentation is what truly matters here.
Why is the gross so important?
The gross presentation shows the stakeholders the exact operational dynamics at play. It shows that you earned your expected yield, but your credit underwriting suffered degradation.
You aren't allowed to just net them together and show nothing.
Exactly. You can't just hide a bad loan by offsetting it against good interest.
It forces absolute visibility. It deliberately prevents the good news from hiding the bad news.
That is the whole point.
And finally, let's look inside that mystical holding pen. Other comprehensive income. What exactly is sitting in the equity section of our balance sheet?
OCI holds the complex mathematical adjustments that reconcile the operational reality of the P&L with the market reality of the balance sheet.
Okay, so what's inside it?
Inside OCI, you have a net balance. Let's look at the specific components. First, it contains the fair value change of 40 rupees.
Right, the gap between the amortized cost of 110 and the true fair value of 150.
Remember that 40 rupees was calculated after we had already accounted for the 10 rupees of effective interest.
Got it. So you have a positive 40 rupee credit sitting in OCI representing the unrealized market gain.
Correct. But alongside that gain, living in the exact same OCI equity section, is the loss allowance credit of 10 rupees that we generated from the impairment journal entry.
Oh, right, the credit we couldn't put against the asset.
Exactly. So you have a positive 40 and a positive 10. The net amount sitting in your OCI equity reserve is 50 rupees.
Let's do a quick, overarching sanity check on the mathematics of the entire scenario to make sure the universe hasn't broken.
Let's do it.
We started on day one with cash of 100 rupees.
Yes.
Our net asset today is 150 rupees. The total economic value increase of our position is 50 rupees. How is that 50 rupee increase accounted for in our total equity?
Well, the P&L netted to zero, as we discussed.
Right.
But the OCI section has a net positive of 50 rupees, the 40 rupee fair value gain, plus the 10 rupee loss allowance credit.
So total equity went up by exactly 50 rupees. The fundamental accounting equation balances perfectly. Assets equal liabilities plus equity.
It's mathematically flawless. And this brings us back to the source's conclusion, and really it highlights the profound elegance of Ind AS 109 when applied correctly.
Elegance is a strong word for something so complicated, but I see what you mean.
It provides stakeholders with the whole unfiltered truth. It gives them the actual market value of the asset on the balance sheet.
Check.
It gives them the pure operational yield in the P&L.
Check.
And it isolates and highlights the specific credit risk without letting one single metric obscure or drown out the other.
The standard deliberately forces you to dissect that unclean fair value movement into its raw component parts so that management cannot hide deteriorating credit quality behind the mask of a booming bond market.
Exactly. Before these rules existed, during the older incurred loss models, companies could delay recognizing credit losses if the overall fair value of the asset was still high.
Which seems crazy in hindsight.
It was. They could hide the fact that a specific borrower was failing because the macro environment was lifting all boats. And AS 109 completely dismantled that hiding place.
You know, when we started this deep dive, that core listener query, how is it possible to segregate the impairment out of fair value, seemed like a completely unsolvable riddle.
Felt like trying to unbake a cake.
Yeah. But by walking step by step through the necessity of the dual tracking of amortized cost, and by understanding other comprehensive income not just as a random bucket for leftover numbers, but as a critical structural reconciling mechanism, it actually makes total sense.
It does.
It is undeniably complex, and it requires serious effort from finance teams, but it is deeply philosophically logical.
It demands a rigorous conceptual understanding from anyone working in finance, which is exactly why resources like the Gap Advisors Issue Repository are so vital to the industry.
You really need a guide.
Absolutely. When you are doing these entries, you aren't just blindly applying arbitrary rules from a textbook. You are systematically mapping incredibly complex economic realities into a highly specific structural framework.
Right.
If you don't understand the why, you will inevitably mess up the how.
And speaking of mapping realities and understanding the why, that leaves me with a final provocative thought for you to mull over as we wrap up.
Ooh, leave them with a cliffhanger.
We've spent this entire hour analyzing how to hold this asset, how to track these parallel realities, and how to quarantine unrealized gains in OCI. But remember the core premise of the FVTOCI business model. We know the entity is in the practice of selling these assets eventually.
That is why they are in this category in the first place.
Right. So think about this scenario. When that day finally comes, maybe 2 years from now, and this debt investment is actually sold into the open market for cold, hard cash, How does that tangled web of OCI holding pens finally unravel into the real world?
That's a great question.
When the unrealized finally becomes realized, what exactly happens to that 50 rupees currently sitting quietly in equity? Does it finally crash into the P&L?
It has to go somewhere.
And perhaps more importantly, does this complex dual tracking reality actually change how a CFO behaves when they are deciding which specific portfolios to liquidate during a cash crunch?
If selling a bond triggers a massive reclassification from OCI to the P&L, does that accounting mechanic drive the economic strategy?
That is the ultimate question. The mechanics don't just report the strategy, they actively shape the strategy.
They absolutely do. It's a fascinating behavioral economics question driven entirely by journal entries.
Well, we have thoroughly unpacked this one. We want to deeply thank you, our audience, for your time and your incredible focus as we navigated the intricate math, the macroeconomic scenarios, and the underlying philosophy of Ind AS 109 today.
Thank you for joining us on this deep dive.
We have a quick favor to ask before we let you get back to your spreadsheets and your audit documentation.
Please do.
Please follow or subscribe to the Gap Advisors Ind AS Clinic podcasts on Spotify, Amazon Music, or YouTube, whichever platform you prefer to listen to Gap Advisors Ind AS Clinic podcasts on.
And please, share this deep dive among your contacts, your colleagues, and especially your audit and finance teams.
Our core mission is to spread deep, practical knowledge on the application of Indian accounting standards, and sharing this episode is the absolute best way to help us do exactly that. Until next time, keep digging into the numbers.